네, 버나드 케인과 함께하는 미국 주식 시간입니다. 구글링에서도 나오지 않던 정보들 그리고 미국 시장에 대한 분석들 전해드리는 시간입니다. 최근에 이 국내 증시뿐만이 아니라 글로벌 증시까지 함께 투자하시는 분들이 굉장히 많이 늘었습니다. 이 글로벌 증시, 특히나 미국 증시에 대해서 얼마나 더 성장할 수 있을지 궁금증이 많이 증폭이 되고 있고, 특히나 이번 달, 지난달이죠. 1월 달에는 미국 증시가 급락했기 때문에 연말까지 어떻게 흘러갈까 궁금하신 분들 그리고 걱정되시는 분들도 굉장히 많습니다. 오늘 이 시간에서는 미국 시장의 건전성에 대해서 한번 이야기 들어볼까 하는데요. 말씀 바로 시작해 주시죠.
When we think about the health of the stock market, what we want to look at are a couple of different things. We want to understand which sectors are showing the best growth, okay, right now, which sectors are performing the best. And when we look at those sectors, how is the profitability of those sectors? And then we also want to look at, and we've talked about this several times before, we talked about it in July and August when we said that the internals of the stock market, the smaller stocks were underperforming relative to the top tier stocks. We then talked about it again in late November. And what I want to do is show what's happened during those periods. So when we look at the sector performance right now, this chart current here is a reflection of all of the different sectors in the market. And we can see that the energy sector is the strongest performer this year so far, followed by the financial sector. Every other sector is down on a year. The worst performing sector is information technology. Now, when we go to the second chart and we look at this, this compares where we've been for all those sectors going back 4 or 5 years. So when we look at the sector that's done the best, information technology. When we look at the sector that's done the worst, it's energy. And so what we know is the market is driven by the most profitable sectors in the market, okay, and the best revenue growth. And the best revenue growth over the last few years has been in information technology, in software and hardware. It has not been in energy. Energy is more of a defensive play as opposed to a growth play. Right now, what we've seen is a lot of people selling growth over the course of the last, say, 2.5 months and buying value. Well, that's great, but that's a very defensive play. And once they're into value and the stock market starts to go up, they underperform. And that's what happens. That's why most people underperform the market, is because they're not in the best growth areas in the market as a whole. They're in the more of the Procter & Gamble names, the Exxon names, different names like that, where that growth is pretty steady all the time. We sell only so much soap a year. We, believe it or not, sell so much gasoline a year. But when you look at information technology, all of a sudden that growth is explosive. So let's go to the next chart. Now, this chart, this is a reflection now of when I talk about the internals and the stocks that aren't performing. This chart right here compares for the last year the percentage of stocks that are above their 200-day moving average in the NASDAQ. Okay, and we can see that sometime in late September, we went from above 70% of the stocks basically above their 200-day moving average to now below 70%. These stocks are above their 200-day moving average. If the market's going to turn healthy, it's got to get back above here. We saw a great rally in early October, and that came from this move right up here. But we never got back into the same space that we were in before. For the stock market to really do well, we've got to get this line back up. And I think things kind of come and go, so I believe we're going to go back up at some point in time. Right now, we're down here because we're absorbing all these selling by people that don't necessarily want to hold the growth stocks currently. So once they're done selling, I think we're going to see, because we've seen some pretty depressed prices, we're going to start to see this line go back up above here, and I'm going to monitor for that. Let's go to the next slide. So we've talked about the advanced decline line before on the NASDAQ and how it differs when we look at the entire 2,500 stock basket of the NASDAQ stocks, and we don't just look at the NASDAQ 100. And we can see the health of the stocks that are basically, let's say, mid-tier. There's always some stocks in the NASDAQ index that really shouldn't be in there. They're just not big enough. They're not strong enough. They eventually wind up getting kicked out and replaced. But the center core is important to us. When we talked originally in June and July, I said that this advanced decline line was underperforming, and I just didn't know if we were going to be able to monitor and stay up here. We wound up having a sell-off. That line started to flatline out, and this was that October rally that we just talked about. Okay, but since mid-November, we've had a market decline in this. And we may have that decline for a couple of reasons. We may have had that decline because people were tax selling because they're concerned about interest, our tax rates going up in 2022. They could be taking profits. They could have purchased stocks at a price that probably didn't support 3 to 5 year earnings growth and stock price appreciation. Say, for example, Bill.com, which went from $100 to $400. And if you bought it at $300 or $330 and that stock is now trading $280, you're concerned. And then that stock trades $250, you wind up selling. And so what we've seen is growth stocks being sold to buy value stocks. And maybe I think a lot of it is an overly concerned focus on anticipatory Fed moves and what that implication is. Just because the Fed raises interest rates doesn't mean that the market goes down. What we have to see is bond yields go up faster than the inflation rate, and we're nowhere near those levels. Let's go to the next chart. So this chart right here takes that same advanced decline line that we looked at over the course of the last year and looks at it over the last 20. So we know we've seen a complete erosion in the middle tier of the NASDAQ stocks. Well, where does that erosion fit relative to where it's been in the past? These circles right down here, 2009, 2013, 2016, late 18, early 2020, and current. These are all the spots where we had a low in that advanced decline line on a composite basis. And you can see that once we started turning up from every one of those spots, we had a significant rally. So the question becomes is, where are we going to turn up from, and how soon is that going to be? Is it going to be in the first quarter? Is it going to be in the second quarter? And I think we're just going to have to monitor to wait and see what that happens. But I do believe that we've absorbed a lot of selling over the course of the last 6 weeks. Let's go to the next chart. Now, this is the same chart we've talked about also before, the number of new highs versus new lows. A healthy stock market makes as many a little bit more new highs than new lows. New 52-week highs versus new 52-week lows for each stock. So when we think about all the stocks in the basket, how many of them are making new 52-week highs today versus how many of them are making new 52-week lows today? And we can see that most of last year, we were hanging above zero on this thing. So we were making more 52-week highs than 52-week lows. But look at what happened in mid-November to late November. Once we hit this market up here, we started making substantially now more 52-week lows relative to 52-week highs. Once again, we need this thing to go back above zero. We need the market to try to make new 52-week highs versus new 52-week lows. This is going to take a minute to occur because if we're just making a new 52-week low it's going to be hard to go back up and make a new 52-week high. But we want to be monitoring this because this is going to be how we found great attractive prices. Let's go to the next chart. So let's look at that same chart, same that I do before, over the last 5 years and say, where have we set our bottoms in, okay? Back in late 18, we set our bottom right here and the market bounced off. This was a seminal event. This was the COVID onset in early 2020, and I think that's a once-in-a-generation buy opportunity. So that number became so deep, and now we're back in here to where we found these same levels. We want, obviously, this to bounce back up again, but you can see sometimes it goes up pretty quickly. So we're at a place now where it's an interesting spot, and what we need to do now is to monitor this for the anticipatory move back up so that we're making more 52-week highs versus 52-week lows. This is one of the reasons why I think the market is set up to be able to provide some kind of buying opportunity going forward. And don't forget, we're still thinking about 8% earnings growth for this year. It's a positive environment for earnings. And I think once we get rid of Omicron, that we're going to start to see the economy open up more and more.